Hey everybody, it's Larry Berman here. Another interesting week in the markets. We learned a lot. Last week we talked about the importance of the presidential election night gap. We got down to it early in the week prior to the inflation and retail sales data. We got softer data this week. Markets respected the support and rallied, but we're still in the range. One thing that's different now than I would say any time in the last couple of years is that we actually have some notable term premium coming into the long end of the bond market. And that is people are starting to get paid to take a little bit of risk. We've talked about this quite extensively in the last couple of years with inflation and the inverted yield curve. So we now have this steepened, or not steep yield curve, but steeper yield curve. The term premium is defined by, what bonds are trading at relative to cash. So what is the risk you're taking to take that extra term in your loan? Or in your purchase versus the rate of inflation, because the longer you hold a fixed income asset, the more you have that purchasing power potential decay. So that's really what's term premium. There's a lot of ways to calculate it. There's some academic papers out there that kind of help with this, but the Federal Reserve of New York has a couple of indicators that they track. I think Waller this week talked a little bit about term premium in some of his commentary. I guess he's in the race to be the next Fed chairman. So he's getting out there talking about, call it, more sophisticated things. So the first graphic we're going to share with you looks at a couple of different measurements of term premium, and we'll equate this to the long bond and the support we saw come into markets this week at a key technical level on TLT. So, in the last few weeks, months of inflation picking up again, long bond yields backing up significantly. This blue line is the one that I like better in terms of the measurements. And it's also a daily update versus a weekly for the other one. Both of them come out of New York Fed paper research over the years. But you can see in the last couple of months here, this real big move up from the zero level. For the most part, with the inverted yield curve for years, flat, long end, you had this negative term premium. People were just not getting paid to take interest rate risk. And while we saw that on the spike in yields above 5% in 23, now with the curve positively sloped and the Fed actually starting to cut rates, debatable how much more is coming. There's a bit more term premium. So, when that you translate that into the TLT and you go back into 2023, we got down into this area of support. Now in 2023, yields pierced the 5% level. This week, the 30-year hit the 5% level, but didn't get through. And so does it or doesn't it? The answer is we don't know. We will learn that on February 4th as Scott Bessent went through Congress, in all likelihood will be approved as the new Treasury Secretary. Talked about a lot of things, but nobody really picked his brain on this too much. He's an outspoken critic of Yellen policies. The thought is that he's going to issue more coupon, and the question is, does he or doesn't he? And so the bond vigilantes, once he was nominated, front run the long end, pushing it back. There's not a lot of juice left above 5% if you're talking about risk return on the long end. So, we saw some short covering, but the question is, can this rally again? And the only way this rallies again, if we see a successive number of months of falling inflation and that in the February 4th update in the quarterly refunding, you get a clear message that they're not going to issue a lot more long-term paper. They'll continue the policy of the Yellen Treasury regime, which doesn't seem likely, and that would, give us a rally back to 95. The whole idea of the debt ceiling probably in the first half of the year gets resolved. And in other words, will the Tea Party part of the Republican Congress allow them to abolish it? That's what they want. That actually makes sense because the whole debt ceiling idea just causes anxiety, and it really doesn't mean anything because they move it constantly anyways. Government's been operating under continuing resolutions for a couple budget cycles now. That's continuing at the moment. Do they get a longer term budget deal? I don't know, but it was pretty clear from the Senate's comments to Congress this week that if they don't extend the Trump tax cuts come the end of this year, it would be catastrophic in terms of consumer spending. I haven't done the math on it, but that seems pretty harsh. It's clearly he's pushing Congress towards that. Again, that means more spending, more deficit, and so forth. But for the next few months, as tax receipts start to come in, into April, Q1 here's probably okay. The Fed probably doesn't need to term out the debt. So, not the Fed, sorry, the Treasury. So that refunding announcement is going to be really, really big. But in terms of additional supply, we're not likely to see that in the short run. So my point is that we're probably balanced now. We probably drift between TLT 85, maybe into the low 90s, but not outside that range. So for me, I'm writing puts below, I'm writing calls above, I'm taking extra premium on my bond fund and just adding value to investors. When there's evidence of a harder economic landing, TLT 100 plus is in the offing. And so you want to set up for that. You want to be a better buyer in the long end. When that translates into equity, so what did that mean this week? Obviously, we came down, we tested the high end of the election night gap, or the low end. That gap's been closed now. So that support has been established. Can we make a higher high? So that's really what's in front of us here in the first, month of the Trump, or the first 100 days of the new Trump presidency that will start on Monday. I'd be shocked if the equity market can rip higher here. So earnings have to be phenomenal. Started okay with the banks, the regionals not so much. But the money center banks, the ones with capital markets exposure, good numbers overall. Regionals, still a lot of concerns about commercial and office in terms of their loan portfolios. So I think we're range bound here. And in a range bound market, there should be some trading opportunities on both sides. I suspect we're going to come down to test more important support levels before we can break to new highs. And again, what's required for the multiples to expand here to break to new highs? It's got to be earnings driven. It's got to be good fundamentals. It's got to be policy that would drive economic growth. So we'll see what the first 100 days brings. But for right now, seems we're range bound. Look out below if that support we made this week doesn't hold. Have a great week, everyone.